Tamar Essner, principal at Vectus Energy Partners, and Bob Yawger, Director, Futures Division at Mizuho Americas. And we want to talk all about commodities, oil in particular. Bob, you know, there was an interesting article from Barron's saying that oil or commodities had run up. Commodity stocks caught fire. Now it's time to get out. Some of your thoughts on what's going on in the world of crude oil?
Well, it's when the OPEC folks 2 weeks ago came out and said that they were going to come in and possibly start adding barrels back to the market in October, we had a big sell-off, and we traded to multi-month lows. They're threatening to add barrels to a market that is already oversupplied. OPEC has taken a good 4 to 5 million barrels off the market. We already have 4 to 5 million barrels of overproduction as it is that they have in their pocket. It's a lot of barrels, and they're saying they're going to start adding some back. The market does not need those barrels right now.
And overall, too, as the Fed decided to stand pat tomorrow, there was also talk how crude got a little boost on that as well, as the Fed, you know, is not making any moves at this moment. Some of your thoughts on what's going on with oil?
Yeah, so to Bob's point, there's a lot of oil, and OPEC clearly telegraphed their desire to bring even more barrels on. So really, for you to be a bull, you've got to be riding on the whole seasonal trade and hoping that the weather is really hot and that there is more power burn in Saudi Arabia, potentially in Asia as well for AC demand, and that people are traveling. And so far, we've seen that demand growth is overall above trend. When you take out the recovery years for COVID, it's above trend, but it's not as high as OPEC had been forecasting. So our numbers suggest about 1.3 million barrels a day of demand growth. That's really solid, but well below OPEC's forecast for about 2.2 million barrels a day. In the context of China slowing, that's going to leave a lot of bulls scared to take bullish positions.
Look, we're in the midst of summer driving season, some heat waves, and even in New York, Bob, you noted in your note how we're getting some hot weather. What does that mean for oil? Where do you see oil? You know, what's the path of least resistance? Is it heading up to 90 or heading down to 60? And what stocks do you maybe think may benefit in the next 6 or 12 months?
Well, I think natural gas stocks will do well because we do have a big heat dome settling in over the country. We're going to start getting some pretty high temps here in the tri-state area. This is the most densely populated area of the country, so it really matters. We're going to get highs in the mid-90s by the end of the week. That will be a natural gas load, heavy load. We're going to have to crank up some natural gas, so there's that. The other side of the coin is gasoline. Gasoline has not been performing well here. You send a barrel of crude oil through the refinery, it comes out a barrel of gasoline on the other end. Right now, you're getting $23 for that barrel of gasoline. Last year at this time, $37. It's not working for the refiners. So my opinion, you'd be a buyer of a natural gas name like EQT, let's say maybe Chesapeake, CHK. You'd be a seller of some of the refiners, Marathon Petroleum, MPC, Phillips 66, PSX, and play that gasoline versus natural gas spread there.
Wow, I'm glad you mentioned some of those names. And, you know, with the buys and sells. And Tamar, is there sort of headwinds that you're thinking of? And where do you think is the path of least resistance for the level of oil where it could be trading?
Well, I think oil prices going down to the mid-70s was a bit oversold, particularly going into the summer months. Demand should materially improve over the summer. And so we see that the speculative positioning in oil is still very low. Short positions are still very high. So I think that in the short term, the path of least resistance is higher. Could we touch 90? Yes. Do I think we'd stay in upwards of 90s for a long period of time? No, I just am not seeing enough demand to warrant that, unless there is, some severe escalations geopolitically, or else, really severe weather that really warrants more oil being used for power generation, which, to to Bob's point, usually in the Northeast, it's mostly natural gas. So we sort of see like an inherent ceiling in oil prices sort of at the $90 level, especially going into an election season. I think that there'll be a lot of focus on the Biden administration on gasoline prices. So we potentially could see more SPR releases if warranted. So the higher oil prices go, the more likely there is to be an SPR release, and the more likely China taps off the gas in terms of buying for their strategic inventories. So we don't see much upside for oil prices beyond that. At the same time, with it being a higher demand season, I don't see oil, really sticking in the mid 70s for too much. I mean, I think it's really supported sort of at an $80 level.
Yeah, thank you, Tamar. Just 10, 15 seconds, but just a thought, Bob, maybe on EV demand, climate, I don't know, anything else, that AI, anything else that may be affecting this group. A few seconds.
The gasoline situation is lacking. The refiners just not getting paid to make the barrel. That's a very negative. You don't need gasoline. You don't need the crude oil to make the gasoline. And we're having that threat in summertime. That's not good.
Thank you both so much. Tamar Essner, Invectus Energy Partners, and Robert, we call him Bob Yawger, Mizuho Americas. Thank you both so much. Nice to see you.